All right, good afternoon, everybody. Chris Lester here, check, radio check. I want to welcome all of you to this call. I've been away for a couple of weeks. I was on vacation with family down in Florida, much needed, and really had a good time. It was, with my younger girls, my wife, her parents. Disney is celebrating their 50th anniversary, as well as my in-laws were celebrating their 50th anniversary. That coupled, my mom and her husband were able to join us in Disney for a day, and that was really nice to see them as well. So overall, it was good, but no sooner did I get back, I had to turn around. What was interesting is in Disney, and we were able to do Universal Studios as after a 3-day park. I have not been there. If I was, it was a long time ago. And what's interesting is those are the big guy roller coasters, the big gal roller coasters. My wife and my in-laws had no desire, but I can tell you some of those roller coasters were pretty cool, but even I'm getting up there, you get thrown around a little bit, but it was really, really exciting. But both parks had a policy with the COVID, mask, that if you were outdoors, you didn't have to wear a mask, but if you were indoors, you had to. It was mandatory. So, we had lanyards and could put them on and off. And in Disney and Universal, it was like clockwork. I flew home and Sunday, and then that Wednesday of that week, I had to fly back to Jupiter, which is why I was not able to do my call last week, to see some of our advisors in Florida. And in other parts of Florida, it is the wild, wild west. I don't know that I saw anybody wear any mask anywhere. And then lo and behold, we had the Super Bowl in California. And I mean, it was a spectacular, not only game, but halftime show. But I was noticing the entire audience, nobody had masks. So hopefully COVID is getting to this point where, I try not to listen to the news and media. Obviously, we're going to follow the law. But myself and the people that I'm seeing around are really, feeling that hopefully this is starting to get behind us. But that brings us to other things. So if you've not been on this call before, typically the format is about 15 to 30 minutes. Once a month, I do a market recap, sort of a Monday day quarterback review of the month previous, right? So we just finished up January. And, you will see that we typically have on the equity side, we have, a month to date and then a year to date. And then we will also have on the income side, the income portfolios, we also have a month to date, year to date as well. However, because it's January and we started with a clean slate, both of those slides will be identical. So as most of you are aware, the media revolves around news. And right now, I think there's two topics that are really, really prevalent and being discussed and thrown around on every channel. The first is inflation. And the second is Russia, or when is Russia going to invade Ukraine? I thought it prudent to say, part of, my experience, 30 years as a financial advisor, and part of, I feel, my responsibility to convey to my clients and to the public is helping folks to manage emotions, right? To not make knee-jerk reactions. So as we look at this first slide, you're going to see, it's really hard to see, right? But what this is, Brookstone, my RIA, has put out, and I'm going to blow this up for us, but I didn't want to try and take a bunch of snippets or whatever, so I'm going to end the show. But this is Brookstone, CIO note, geopolitical events. That's what this slide is saying. And I'll blow this up, but I'll start at the bottom, because this is what this is. We'll look at the columns first: S&P returns, and then the number of days, bottom and recovery. Now, I could obviously start from the most recent, but I wanted to go all the way back and start at the end, right? North Korea invades South Korea. So in the 1950s, the market at that point in time dropped 5% in one day, but the total drawdown was about 12%, 13%. And that took about 23 days to hit the bottom and then 82 days to recover. But this average number, you're going to see all this data, the spikes that we've had has really resulted in about 1%. And this is why there's been some studies done that investors that typically do and manage their own portfolios without a financial advisor typically miss the best days in the year. They get out at the wrong time and they get in at the wrong time. But this source is from LPL Lincoln, right? Research, S&P Dow indices, you can read this yourself. But what I wanted to show you was this little blurb up top. News has spread that Russia may invade Ukraine. Investors should be aware that there is likely to be a knee-jerk market reaction. But geopolitical events often do not have a lasting impact on financial markets. The table below provides a good framework to see how stocks have responded to other geopolitical events. The average one-day decline is about 1%, with the total event driven downward of about -4 over 16 days and then recovering in about a month, right? So I'm going to go through and just point out some things that, some of you on the call may have lived through. Some of you just heard about way back when. Right. So the next one, Kennedy assassination, right before the year I was born, -3%, one day. Right. If we go and look at, let's say, I remember the Munich Olympics, right? 0.3, we got the Olympics going on, -4, 42 days to its bottom. And then it took about 2 months to recover. The Reagan shooting, right? 1981, again, not even a full point. 1 to 2 days, top to bottom. Iraq invasion of Kuwait, that was in the 1990s, right? Down 1% with its, total drawdown 17%, with a bottom of 71 days, and it took 6 months to turn around and get back for recovery. U.S. terrorist attacks. So this is 9/11, right? Down 5%. Total drawdown 12%, bottom was 11 days, and we recovered in a month. And that shows you America's resiliency. And this is when we were attacked. If we go, Boston Marathon bombing, -2, 3%, was down for 4 days, and then 15. And then I'll just talk about, the North Korean missile crisis, right? Down, not even a blip, total drawdown 1.5, bottom 14 days, recovery 36. My point in sharing that is the market has been in a downward pressure. And I was reading an article here. Here we are halfway through Q1, and the outcomes for equities and bonds have only gotten worse. Big news in the fixed income market. Even to market veterans like ourselves, it is still amazing to see that in less than 6 weeks, the Barclays Ag has given up over a year's worth of income and has performed worse than the entire calendar year of 1994, which is still legendary for bond market carnage. Now to equities. Despite the valiant effort of dip buyers, the S&P has continued its downward trajectory, driven by escalation, inflation, and more aggressive potential Fed tightening, combined with the threat of Russian invasion of Ukraine. So what does that mean for the 60-40 portfolio? The hangover for the dramatic outperformance of risk assets and 60-40 equity bond allocations compared to the real economy in 20 and 21, driven by massive monetary and fiscal stimulus, is approaching the migraine stage. The combination of fiscal and monetary policy, large S, has now accumulated in the highest inflation levels of the past 40 years, which in turn is forcing the Fed's hand to remove the punch bowl far more rapidly than market expectations as recently as 6 weeks ago. The resulting market turmoil was as predictable as the sun rising in the east. Now the good news. The good news is, just like the Fed's large S impacted asset valuations far more dramatically than the real economy in 20 and 2021, the tightening of the Fed policy should continue to weigh far more on capital markets than on the real economy. So basically, what does that mean in English? It means relax. Things are going to be okay. Where I will say, though, we have in the past cautioned about bond and waiting in the bond portfolios. You'll see here in the next couple of weeks, I'll be doing some email blasts that one of the carriers that we use in the first time in my career, 30 years, right, plus, Allianz has a 35% buffer added to people when they give them money for their annuity. Now, that annuity has some bells and whistles and unique features, but a 35% bonus, to basically what I use this for is a bond alternative to help people balance out their portfolio. The other thing I'll point out to you is that even though we look at these indices and we see the S&P and we see that's down, roughly to 4,400. Its 52-week high was 50 or 4,800, right? It's less, it's about 1% right now, right? And then you have the Dow that's down 600 today. So we as an economy, as human beings, as a society, have gotten used to this volatility, right? And so what we're always, especially as we approach retirement, a lot of us don't have that stomach for that. But most of us are not in the Dow. Most of us are not only in the S&P. So you have to temper the information that we're getting on the news, because remember, the media makes its money in fear and greed, right? Those are the two areas where it's gonna tout from the rooftop, one of those two features. This is another slide that I think is important, which is just, it goes up from 1980 to 2020, but it shows every year, it's on a calendar year, and it shows that, hey, listen, what are its highs and what are its lows on different points? And what was interesting is, even though all these red dots, it had low points within the year, it's not where it necessarily ended up. So on a year like here, in 2006, 2007, housing bubble burst, down as far as 49, but it ended up coming back. But that goes back to my point, where a lot of times human nature, emotions drive us to get out of the market at the wrong time. And I'm certain a lot of you with your 401ks at work are feeling the same way. You're like, maybe I should just get out. But unless you need the money tomorrow, right? I'm going to suggest, hey, listen, ride the storm. Don't make knee-jerk reactions, or create a strategy that helps buffer some of this volatility. So now on to our slides. I hope that didn't bore you to death. I hope I wasn't speaking too quickly. But for those of you that have not been on this call before, this is our equities slide. And notice for the month of January, no equities was really positive, except for the pink, which is China, which broke even, right? So what does this show? It shows that commodities is where some money is going into, typically that's heavily weighted in oil. But all these other ones, the S&P, right, which is the red line, you got blue chips, which is the blue line, you got real estate, you got European markets, which is the teal line, all of these, and even gold, which for a couple months there has been getting beaten up. You may see that this becomes a fan again, because people typically, their flight to safety when they get spooked is going to go into, the gold or treasuries. So the next slide is going to be the exact same thing. So there's no mystery here. So when you're not seeing things, so notice it says growth markets for January, then the next slide is going to say year to date. So year to date, nothing changed, because January and January match. Now, when I do this in March, right, obviously we'll have 2 years of data, so this slide will be different. So, so in the spirit of not boring you to death, I'm going to move on to this slide, which is the bull bear indicator. So remember, this is the three Weisman, and going back to 2000, right? Whenever these three indicators, the relative strength index, right, the moving average, or the MACD, moving average, convergence, divergence, if all three of these cross over, it will create a signal that, hey, listen, it creates a red line, which means there's storm clouds ahead, could have choppy water ahead, could be heading into a downward market. That has not happened yet. Doesn't mean it can't, right? Because this was overbought, right? But it seems like it backed up. We'll see where this ends up here. And right now we're close, right? So that we're on this upside, and this is not tripped, but we're watching. And as I had said at the beginning of the year in January, that our chief investment officer says, listen, we should probably see some type of correction or pullback. And typically those are in the 15 to maybe 20% range around June, July, the end of the second quarter this year. So I guess the reason I wanted to emphasize, and again, I've been away for 2 or 3 weeks, so I just want to make sure that everybody on here just don't panic when you see things on the news that everything is going to hell in a handbasket. It is not. Inflation is here. You feel that at the pump. That is, things are costing more. The Fed is probably going to raise interest rate in March. And why do they do that? Well, because if things become too expensive, they have to tap the brakes. And monetary policy is one of the things that they do to be able to sort of slow people's spending. If they make it more expensive, Therefore, demand is not there. Prices tend to drop back into line. That's the theory. It's been proven to work in the past. They've been printing money for a decade now. So right now you're going to start to see that, hey, listen, as much as I've been talking about inflation for 5 years now, and it's now come to fruition. I'm not smarter than everybody else, but it was just logical when you continue to print money and turn around that at some point in time, the economy is going to heat up. And that has, with the supply chain, right? The underlying economy and, the labor force, those are good. That's why the article I was just reading to you, those are good signs. There's employment, there's people spending money. They're just, right now things are just more expensive. So let's look at the income markets, right? So if we look at the month of January, right, what has done well? And if we look at 0%, which is this line, anybody that is on an income portfolio lost money for the month of January. And, it's hard for somebody that's not living on a fixed income to recognize this, but this is a big deal. If you were counting on getting $1,000 a month from your investment, and now I'm not getting $1,000 a month, the bond portfolio that I bought into and was told was going to generate revenue has lost value because interest rates go up. Well, maybe I only get 900 now. Well, how do you pay your bills, right? The landlord or the PSE&G or the water company, they don't want to hear that, hey, listen, I didn't get as much this month. So when we're doing planning and we're looking at this and we start to say, hey, listen, all the theorists and all the people that maybe have no practical experience, right? They just got out of college. They say, I'm going to be a financial advisor, or they're working for some large investment firm. They say your portfolio should be 60-40. You're 40 years old, you can afford the risk. Oh, you're 55 years old, you can be, you still got 15 years, you can do 60-40. Or you're getting close to retirement, you're 50-50. Well, that's great in theory, but when your portfolio, the 50% that's in income, loses 10 or 20% of its value because interest rates, which everybody that I speak to now gets it, are going up. And interest rates and bonds have an inverse relationship. So if you are owning bonds or bond funds and they turn around and interest rates go up 1%, right? And I just looked up a 30-year mortgage, we're up around 4.4 now, right? Just a year and a half ago, we were in the twos. So that's where you start to do a pulse check on where are interest rates at. And now it's already been announced that the Fed is going to come out and raise interest rate to curb inflation. Well, now your holdings on a personal level, either in your 401k or some type of strategy that you put into that includes some type of bond portfolio, is at risk. And now you turn around, this slide is the same. I went from year to date or January to year to date. So nothing changed there. But just be aware that, I don't know what next month's going to be, but likely, like I said, using piloting terms, if I see storm clouds on the horizon, I tend to try and go around the storm, not through the storm, right? So again, having strategies where we can reduce some of the volatility, maybe reduce some of the bond risk, because I think we need to be in equities, right? Long term, right? Where else are we going to get a reasonable rate of return? But that's just based on what I've seen over my experience. And lastly, here's the three Weisman chart for the bull bear indicator aggregate bonds, right? Nothing has tripped. Bonds have been on this upward trend, right? You see this green line, but starting to see a sideways channel here, right? So as we start to see that, we touch base here in 2021, and now our 2022, we see this dip. So we don't know where it's going to go, but it is likely, I would think, some point in time here in 2022 that we see a red line. And then you'll start to see the bottom fall out. So the last slide is a slide that's unique to Brookstone and came from Formula Folios. It's a recession probability analytics tool. And it says, how likely is it that a recession is upon us? And this black line in the middle just shows, hey, that's a 50 percentile. If we get over this, and the only time in the last 2 years that happened is when COVID hit, right? We went above it, went into the 60, 70 range, and then it swung back down. But you can see that we've been on this sideward trend, right? But in the last 3 months, it's been ticking up. Does it mean a recession is coming? No, it's just taking variables from about 100 different indicators and saying, hey, based on these factors, it is, if it gets above 50, caution should be exercised. So, that's the slides that I prepared for this week. I really do appreciate you guys taking time out of your work schedules, hopping on this call every week. Some of you are my clients, some of you are some of our advisors' clients. But if anybody ever has any questions, right, we're one phone call away. Understand that, as much as you think you can do things like investing yourself, and you may be able to, but it's the managing the emotions that tends to get people a little bit, create agita. So here's my email address, chris@professionalplanningservices.com. If you have any questions, please reach out. I think next week I'm going to probably talk, because that annuity that I was talking about that has a 35% bonus is only from February 22nd to April 11th. There's a very finite window. It is not for everybody, right? But if you have probably 11 years to retirement and you want to start to add a bond alternative, this might be an option for you. So, make sure you're on the call next week. I'll talk about it and highlight and spotlight some of the features of this. I've used it before, with a lot of my clients that are over the years, and it's performed well, but it's taken some of that risk off the table. So everybody on the call, hope all is well. Have a great day. Thank you. Bye-bye.